Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, November 19th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. So let's hop right in. Today's key macro question is, why are crypto and commodities breaking down? The short answer is because the ebbs and flows of the liquidity cycle are felt soonest by assets that are farthest out on the risk spectrum. Peripheral vasoconstriction occurs in the global financial system just as it does in the human body. And for those of you who may not be familiar, this is pretty morbid, so close your ears if you don't want to hear it. But peripheral vasoconstriction is what happens to your body when you're dying, when you're in shock. Your body stops pumping blood to your fingers and then your arms and your legs and your toes so that it can use the available blood supply and the oxygen to keep your body alive by keeping your core organs functioning. And so that same the outcome happens when you have ebbs and flows in the liquidity cycle. Things that are furthest out on the risk spectrum, that are furthest away from the core of the financial sector, they feel the ebbs and flows of the liquidity cycle faster because that's where it starts. That's where that's where the ebb and flowing takes place fastest. So in our opinion, that's part of the reason why crypto and commodities breaking down, because very clearly we're in an ebbing of the liquidity cycle. And so we need to figure out how durable it's going to be and how deep it's going to be. So that's the number one question I think all investors need to figure out in the coming weeks and months. So getting into the analytical nuance, investors are also awaiting minutes from last month's Federal Reserve meeting as fading odds of a December rate cut, now roughly a 50% probability of a 25 basis point move, add to the market's lethargy. Primary dealers have pushed back against pressure from the Fed officials to tap a key borrowing backstop, complicating efforts to calm stress in the $12 trillion repo market, apparently warning last week that the standing repo facility still carries a stigma that could signal distress among borrowers. That stigma, along with operational and balance sheet friction, helps to explain why dealers remain hesitant to use the SRF, which the Fed established in 2021 as a stabilizing backstop for money markets. Recall that short-term funding markets have drawn heightened attention as thinning liquidity has kept repo rates elevated heading into the December 1 end of balance sheet runoff. Policymakers had anticipated tighter reserves would push funding costs higher and pull more counterparties toward the SRF to help restrain repo rates. SRF demand has, however, fallen well short of Fed expectations as institutions tapped the facility for a lowly $50 billion on the final trading day of October, the highest since daily operations became permanent more than 4 years ago, but is a mere drop in the bucket compared to the size of the $12 trillion repo market. The key takeaway here is that the SRF is not designed well enough in its current form to address the uptrend in funding stress in the repo market. The risk to investors is that the tardy Powell Fed does not fix the problem by supplying adequate liquidity on a proactive basis. The risk of a further positioning cycle unwind is elevated if the tardy Powell Fed does what it's been doing for the past 8 years, i.e. overreact, emphasis on react, to lagging economic releases and adverse financial market developments. There's roughly the same amount of time between Tariff Liberation Day and the next Fed chair's first FOMC press conference. And if the previous 7 months confirmed anything, it's that a lot can occur in financial market pricing terms in the next 7 months. As always, members of our global investor community can trust that our institutional grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transitioning to our 42 macro dashboard, as always, a wrap up with the question from our community. This one's titled Japan Long Yields Rising, Noise or Inflection Point. It says there are reports that the long end of the Japanese treasury bonds is rising and said to put pressure carry trades and to bring home foreign bond, from Japan's point of view, bond positions in face of rising hedging costs. The next central bank meeting is said to be December 18th. Is that noise or another milestone in that shrinking liquidity theme as it relates to the dollar, treasury bonds, et cetera? And then there's a second question asking, I'd like to understand how those dynamics are likely to impact us also, based on my limited understanding. One possible scenario is that many foreign investors get margin called, causing a possibly a sudden sell-off in U.S. Equities. So I'll kind of address all that kind of at once. So let me take you to my Bloomberg here, graph 1664, where we show the BOJ's reaction function through the lens of the Bank of Japan's benchmark policy rate, through the lens of the 10-year nominal Japanese government bond yield, the U.S. dollar JPY spot inverted, so down equals down in terms of the Japanese yen, and then the Bank of Japan's balance sheet, their total assets in dollar terms. And so as you can see, the Bank of Japan's balance sheet peaked about in 2020 at about $6.8 trillion, and it's now declined to $4.5 trillion. This has coincided with the increase in the long end of the Treasury curve in Japan, the JGB curve. And part of the reason why we continue to see an acceleration in the JGB curve is twofold. One, Japan has durably escaped deflation. It, in my opinion, is probably the least talked about major global macro force that has occurred for the past couple of years in terms of impacting the long end of the Treasury market and ultimately the amount of liquidity that's sloshing around the global financial sector through the lens of dollar depreciation, et cetera. Two, the Bank of Japan, the JGB market is anticipating further reflation policies out of the new prime minister. I'm going to butcher her name, so I'm going to ignore it, but Japan's new prime minister, I believe it's their first female prime minister, so congratulations to you guys on that. Their first female prime minister is a protege of Shinzo Abe, and as we all know from the Abenomics trade that we helped many institutional investors make a crap ton of money on. It's going back to when we pivoted on that in November 2012. If you recall the Abenomics trade, it was about big fiscal stimulus that gets monetized by the BOJ. And so now the long end of the JGB curve is starting to look around and say, if they do that from this starting point of already having durably escaped deflation, then we have to just reprice the long end of the Japanese government bond market much higher. And the reason this is really important as it relates to broader global financial market risk is because you're talking about a potential scenario where Japan incrementally steps out of the treasury bond market. So if you look at Europe and Japan, which are our two largest foreign creditors from the perspective of capitalizing the U.S. treasury market, our two largest foreign creditors are actually losing money by buying U.S. treasuries and then edging out the currency risk. Right now, if you look at the weighted average 10-year Eurozone nominal bond yield, it's about 3.01% currently. And then if you subtract the cost to hedge dollars from the perspective of European investors, you actually wind up with a negative yield of about minus 86 basis points. So it is not economical for our European creditors to capitalize the treasury bond market here. And the same dynamic is in Japan. If you look at the 10-year nominal JGB yield, it's about 1.77%. If you subtract the cost of hedging dollars from the perspective of Japanese domiciled investors, then you're talking about a yield pickup of about an all-in yield, treasury yield of minus 1.19% once you again factor in that currency hedging component. And so again, our two largest foreign creditors are essentially making somewhere between minus 0.9% and minus 1.2% for capitalizing a 10-year treasury bond. And so obviously that removes a source of demand at the margins from the treasury bond market and ultimately complicates this this desire by the Trump administration to get the long end interest rates down, because again, you're not getting the kind of participation from our two largest foreign creditors that we've historically gotten. And so this is relatively new. This dynamic will persist as long as the market is concerned about dynamics like durable dollar depreciation, which obviously would be predicated and perpetuated by any sort of I would say adverse monetary policy outcome. If the market thought the Fed was kind of being LBO'd by the Treasury, which may eventually happen, is likely to happen in this fourth turning, in our opinion, then obviously you're going to have this kind of sticky dynamic with regards to hedging costs persist. And so as it relates to broader financial market risk, one of the things we've highlighted in recent months in our research is that this kind of whole concept of the yen carry trade, that's not something that we have to be overly concerned about at the current juncture. If you kind of look at the CFTC contracts as a proxy for the amount of yen, this hot money yen carry trades that are out there in the market, if you go back and you look at where we were in June of 2007 or July of 2024, before the last unwind of the yen carry trade kind of major unwind took place, we were significantly net short in terms of the combined futures and options positions in the Japanese yen market. So right now we are actually net long, one of the highest net long readings on record. So I don't think we have to worry about a significant unwind of yen carry trades. They've by and large been unwound from this perspective. But ultimately, I still think the hawkish dynamics that we continue to observe out of the long end of the Japanese government bond market is something that is putting upward pressure on treasury yields, all things being equal. And it's something that we now have to contend with as investors from the perspective of liquidity, because we know that liquidity is inversely correlated to global interest rates. It's inversely correlated to global bond volatility, and ultimately it's inversely correlated to both the dollar and global currency vol. So all these dynamics are at the margins being exacerbated by this hawkish move in the long end of the JGB curve. So again, it's just another one of a series of developing headwinds to our paradigm C bull market that we got started for you back in April. So we'll wrap it up there. Darius still here presenting our macro minute for Wednesday, November 19th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.